What if the next global recession doesn't begin with one massive economic collapse, but with several smaller shocks hitting the world economy at the same time? That is the question investors, businesses, and policymakers are watching closely. A global recession is not inevitable, but the risks are becoming increasingly interconnected. One major trigger could be another energy shock. The ongoing geopolitical tensions in the Middle East have already shown how quickly disruptions to energy supplies can push up oil prices, transportation costs, and inflation. If energy disruptions become prolonged, households could spend more on fuel and essentials while businesses face higher operating costs. That creates a dangerous combination: weaker consumer demand and higher inflation. The IMF has warned that renewed conflict could reignite commodity price volatility, tighten financial conditions, and weaken global growth. The second risk is trade fragmentation. If major economies increase tariffs or introduce restrictions on critical goods and technologies, companies may face higher costs and disrupted supply chains. Retaliatory measures could make the problem even bigger, reducing international trade and discouraging investment. The third danger is high debt and rising borrowing costs. Governments and companies around the world are carrying significant debt. If bond yields remain elevated, refinancing becomes more expensive. A sudden loss of confidence in government finances or corporate borrowers could tighten credit and spread financial stress across markets. Then there is the stock market risk. Markets can fall sharply when investors suddenly reassess economic growth, interest rates, corporate earnings, or valuations. One important risk being monitored is a correction in AI-related investments. If investors conclude that expected AI profits are too optimistic, a major technology sell-off could reduce wealth, business investment, and confidence. The IMF has specifically identified financial market repricing and an AI-related correction as potential downside risks. And here is the biggest concern: these risks could reinforce one another. Imagine energy prices rising, inflation returning, interest rates staying high, debt costs increasing, stocks falling, and businesses cutting investment, all at the same time. That is how a series of individual shocks can potentially turn into a global economic downturn. But there is also an important counterpoint. The global economy has so far shown resilience, and the IMF says risks are more balanced than earlier in 2026. Strong technology investment and other sources of growth are helping offset some of the pressure. So, the next global recession may not have one single trigger. It could come from energy, trade, debt, financial markets, geopolitics, or the combination of all of them. And if that happens, the impact could reach almost everyone. Falling stock prices, weaker corporate profits, slower hiring, reduced investment, lower global trade, and greater pressure on governments and central banks. The real question is not whether the global economy faces risks. It is whether policymakers and markets can absorb the next shock without allowing those risks to feed into each other. What do you all think? Which risk could trigger the next global recession: energy, debt, trade wars, financial markets, or something we are not seeing yet? Let me know in the comments. If you found this video helpful, please subscribe, like, and share the channel.